Hello and welcome to CoinLex. Today we are going to learn Elliot wave theory and how can we use it on our trades. First question, what is Elliot wave? Technical analysts use the Elliot wave theory to describe price movements in the market. Ralph Nelson Elliot developed this theory after observing and identifying fractal wave patterns. It is possible to identify waves in price action movements as well as in consumer behaviors. The term riding a wave could be used to describe trader looking to profit from market trends. As a form of technical analysis, Elliot wave theory looks for the long-term price patterns that correspond to persistent changes in traders' psychology and sentiment. There are impulsive waves that establish patterns and corrective waves that oppose the larger trend. In this table, we will learn the processing logic of the Elliot wave. There are two kinds of Elliot wave, nothing more than that. First one is impulsive wave and the second one is corrective wave. The first part of the impulsive wave is divided into two in itself: classical impulsive wave and terminal impulsive wave. We will also look at their behaviors as well. Corrective waves are also divided into two among themselves, by simple and complex. In simple waves, we see flat, zigzag and triangle forms. The most important thing to know in simple section is that they need to be verified. The complex part is called small x wave and large x wave. This part consists of combination of simple waves. Don't let all these terms confuse you. You will feel more comfortable seeing how it all comes together. And CoinLex has the perfect solution for all this. This is the Elliot wave. We have an impulsive wave side and corrective wave side. The impulsive wave is always denoted by numbers and the corrective wave is always denoted by letters. We need to find the pattern 1 to 5 in the impulsive portion inside each impulsive waves. The same logic for the ABC pattern in the corrective parts applicable to the formation. Now, let's take a closer look at the impulsive wave parts. 5 subwaves make up an impulsive wave, which moves in the same direction as the trend of the next largest degree. This pattern is the most common impulsive wave and the easiest to spot in the market. In the same way as all impulsive waves, it also consists of 5 subwaves, 3 impulsive waves, and the 2 corrective waves. In order for it to impulsive waveform, unbreakable rules must be followed. First, third, and fifth wave must always be leading the wave. The second wave cannot retrace more than 100% of the first wave. The third wave doesn't have to be longest wave, but it certainly can't be the shortest wave. Wave 4 can't go beyond the third wave at any time. If one of these rules is violated, the structure is not an impulsive wave. The trader will need to relabel the suspected impulsive wave. Now, let's examine all the waves in impulsive wave and see how traders' psychology and behavior of the structure works. Wave 1. In Elliot wave theory, wave 1 is rarely obvious at its inception. When the first wave of a new bull market begins, the fundamental news is almost universally negative. The previous trend is considered still strongly in force. Fundamental analysts continue to revise their earning estimates lower. The economy probably does not look strong. Sentiment surveys are decidedly bearish. Put options are in a vogue, and implied volatility in the options market is high. Volume might increase a bit as price rise, but not by enough to alert many technical analysts. Wave 2. In Elliot wave theory, Wave 2 corrects the Wave 1, but can never extend beyond the starting point of Wave 1. Typically, the news is still bad. As price retests the prior low, bearish sentiment quickly builds, and the crowd, haughtily, reminds all that the bear market is still deeply ensconced. Still, some positive signs appear for those who are looking. Volume should be lower during Wave 2 than during Wave 1. Price usually do not retrace more than 61.8% of the Wave 1 gains, and price should fall in a three-wave pattern. Wave 3. In Elliot wave theory, Wave 3 is usually the largest and most powerful wave in a trend. The news is now positive, and fundamental analysts start to raise earning estimates. Price rise quickly, corrections are short-lived and swallow. Anyone looking to get in on a pullback will likely miss the boat. As Wave 3 starts, the news is probably still bearish, and most market players remain negative. But by Wave 3's midpoint, the crowd will often join the new bullish trend. Wave 3 often extends Wave 1 by a ratio of 161.7%. Wave 3 rarely picks up steam and takes the top of Wave 1. As soon as the Wave 1 high is exceeded, the stops are taken out. Depending on the number of stops, gaps are left open. Gaps are a good indication of a Wave 3 in progress. After taking the stops out, the Wave 3 rally has caught the attention of traders. Wave 4. At the end of the Wave 4, more buying sets in, and price starts to rally again. Wave 4 is typically clearly corrective. Price may meander sideways for an extended period, and Wave 4 typically retraces less than 38.2% of Wave 3. Volume is well below than the of Wave 3. This is a good place to buy a pullback if you understand the potential ahead for Wave 5. Still, fourth waves are often frustrating because of their lack of progress in the larger trend. And Wave 5. In Elliot wave theory, Wave 5 is the final leg in the direction of the dominant trend. The news is almost universally positive and everyone is bullish. Unfortunately, this is when my average investors finally buy in, right before the top. Volume is often lower in Wave 5 than in Wave 3, and many momentum indicators start to show divergence. At the end of a major bull market, bears may very well be ridiculed. And this will be the area where the corrective wave will be start. We call our longest wave wave extension, as we mentioned in the table. Our rule of being the longest wave is that the longest wave must be 161.8% longer than the wave that comes after it. It's more likely about the ratio, and these are not random ratios. These are very useful Fibonacci ratios. It's very useful to measure the target of a wave's move within an Elliott wave structure. Different waves in an Elliott wave structure relates to one another with Fibonacci ratio. For example, in impulsive wave, Wave 3 is typically 161.8% of Wave 1. Wave 2 is typically 50%, 61.8%, 76.4%, or 85.4% of Wave 1. You can see the rest of the information here. And traders can thus use this information above to determine the point of entry and profit target when entering into a trade. But calculating all these ratios will be difficult, right? And if we only use the rules we mentioned before, of course we're gonna find very useful Elliott wave structures. And you can see different types of impulsive waves like this. These are all correct, because they are leading all these rules we specified before. The only problem is, will you be able to look days and days to the computer screen and calculate, draw all the numbers and structures like that? The development of computer technology and internet is perhaps the most important progress that shaped and characterized the 21st century. The proliferation of computer-based and algorithmic trading breed a new category of traders who trade purely based on technicals, probabilities, and statistics without the human emotional aspect. In addition, these machines trade ultra-fast in seconds or even milliseconds, buying and selling based on proprietary algos. This is what CoinLex offers you. With one click, CoinLex analyzes all markets and finds the correct Elliott impulsive waves by using Fibonacci ratios, then shares the detections by showing them on the chart with traders. On part 2, we are going to learn how Elliott waves corrective part works, and more features about CoinLex smart algorithm tools. Stay tuned, and thank you for watching us today. CoinLex. See you next time.